webinar. Our topic today will focus on charitable giving. And no matter the stage of financial planning that you're in, many people are often interested in how they can gift to their favorite charities and nonprofits in a tax-efficient manner. So today I'm joined by Chris. Chris works out of our Seattle, Washington office. His areas of expertise include financial planning, retirement income plans, Medicare, and Social Security. Prior to joining Baird, Chris spent decades as a financial planning consultant at Fidelity Investments and Charles Schwab, focusing on investment and financial planning for high net worth individuals and families. Previously, he became licensed in the insurance industry and worked for Washington Mutual. So before I turn the call over to him today, I do have a few housekeeping items that I'd like to highlight. The first is for optimal viewing, we would suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of your screen. All participants are in a listen-only mode, but we would love to hear from you. So we will host a Q&A session at the end of today's call and address as many questions as time permits. You can click on that Q&A icon on the bottom right-hand side of your screen, like I mentioned, and submit a question. Just please be sure that you're submitting your questions to all panelists so that we're all able to view those when we're reading them out to you. This presentation is being recorded and will be available along with the slide deck in about a week following today's call. You can get both of those pieces through your Baird financial advisor or via bairdwealth.com. So thank you again for joining us. Chris, thank you so much for being here. I will now turn the call over to you. The floor is yours.
Great, thank you, Justine. I appreciate that introduction. I'm delighted to be here. For one reason, today we're talking about charitable giving. And for another reason, the audience today is what I would call a select group of people, because not everybody in the country is interested in charitable giving. So whether you've given charitably in the past or are planning on it in the future, you've come to the right place. Excuse me. I've heard some refer to charitable giving as the bright side of the capitalistic coin, and that certainly is true. And so kudos to any of you who have interest in this topic. I love this topic. I've done this sort of presentation in the past, and some of the feedback that I received was that I should try to interject a little bit of humor. So for the next minute, that's my attempt. Maybe if you get the survey afterwards, you'll give me a 2 out of 10 instead of a 1 for the humor. Here we go. So here's a great quote by Abraham Lincoln. Don't believe everything you read on the internet. Clearly, right? And maybe, in fact, he posted this on his Instagram post using a smartphone. iPhone, Samsung, I don't know. In fact, let's, if you would, warm up our question and answer tool with this slide. So in the upper right-hand corner, I believe, you have a Q&A tool. Let's just have a real simple one-word vote. Let's see if we can get this working. Just throw in there, do you think if Abraham Lincoln were using a smartphone, would he choose an iPhone or Samsung or some other option? Okay, we've got some participation here. Excellent. Looks like it's a tight race right now, iPhone versus Samsung. Oh, a BlackBerry. We got somebody still rocking a BlackBerry. That's fantastic. Landline, that's funny. Okay, so actually iPhones have it. I can tell the majority of folks are iPhone users. I would agree. I think what he's got in his hand right there is an iPhone mini. That's my personal choice. Okay, one last little note here about some of the most effective financial education I've ever been a part of was I did employ this quote here attributed to Bill Murray, this advice of teaching kids about taxes. Eat 30% of their ice cream. So the other evening in my home, sitting around with my children at the dinner table, we were eating some ice cream, and without explanation, I just reached over and took my 12-year-old's bowl of ice cream and began eating it. And she gave me the, eye roll, Dad, I don't like you, Dad, kind of, teenager look. She didn't really understand much about the difference between long-term capital gains and ordinary income tax brackets, but I think she'll remember that lesson for sure. All right, here we go. Diving into what we're going to talk about today. We're going to cover a little bit of what's been going on in the world and our country on the lines of charitable giving. We'll cover some tax rules for how to donate properly, and then cover some tax efficiencies that you can employ during your lifetime and beyond and then also talk a little bit about the differences between foundations and donor advised funds. And then we'll wrap it up. So the charitable giving landscape, the easiest way to do that is to start with a world map. So what you're seeing is a very nice looking slide. We've got various colors here. The red represents countries that are more highly placed on charitable giving activity. And the cooler countries in blue, and darker the blue, the cooler, are those countries that are not. This is put together typically every year by the CAF, the Charities Aid Foundation. They do in the field work in most countries in the world to put this together for us. So it's kind of interesting. You can see definitely the United States, I'm proud to see this, is a dark red. We're definitely up there. In fact, if you look at the top 10 countries that the CAF has ranked in charitable attitude, the United States comes out on top. At least that's the trend for the past decade. They specifically put together a 10-year trend for us between 2010 and 2020. And if you're looking closely at this slide, you'll notice that in the upper left-hand corner, there's the United States coming in at number 1. That each of these countries has 3 little subcategories. So there's a blue circle with a hand in it that indicates a helping hand, because they also study not only the money that's given to charity, but also whether people are willing to help. And the third one down, that little black circle, is a clock that represents whether the people are willing to give of their time. So what's interesting is if you look at the little purple circle for all these countries, the United States actually doesn't come in number 1. That percentage is a portion of our citizenship in the country that gives to charity. So it's not the dollar amount, but just how widespread is the activity. So we're not number 1 in that, but we are number 1 with the helping hand. I thought that was pretty cool. The United States, out of all the countries here in the top 10, is the most willing to help out somebody else in a need, you know, fix a tire on the road, whatever it may be, that sort of thing. Pretty cool. Next slide. So now if we drill down more into the dollar amounts, I'd like you to use that question and answer feature again to go ahead and share what you think as a percentage of our country's gross domestic product do people give to charity. So to give you an idea of a range, the 4 runner-ups in this are New Zealand, Canada, UK, and Korea at those percentages that you can see. Go ahead and give me a vote here in the Q&A tool on where do you think the United States comes in compared to these countries. Looking like about 1%, 5%, 20%. Quite a range here. A number of people coming in around 1 or 2%. So the 2%ers, you have it, because the trend really is right around 2%. The year that this was done and dug into the data, it was 1.44. So, you know, 1 or 2% typically is the answer for the United States, which is significant because, as you can see, we're just running alone on the track. The pack is way back there. 2nd, 3rd, 4th, 5th place are all kind of jostling for position, but the United States is well far out in advance of everybody else. I'm proud of that. I think it's just fantastic that our country can lead the way in that regard. So who in our country is doing that giving? Well, it's you and it's me. Here's a breakdown for you. So typically right around 70% every year of the giving, which is billions and billions, is from individuals. So 69% on this slide gave, so 69% of the total amount gave $324 billion. Next up is foundations, and then giving by bequest, so that's wills and so forth, leaving money to people and entities, and then corporations at the bottom. So the reason this is a big deal is because a lot of times when we think about charitable giving, we think, oh, that's something really big in the headlines, like the Bill Gates Foundation or United Way or some of their wonderful organizations such as those. But actually, when it comes to how much is given, it's actually, the load is being carried by you and me, just regular folks. So that, I think, is really significant. And that helps explain why this is one of our really well-attended wealth strategy calls, is because it is the people on the front lines just regular folks who are making this happen for our country and putting up the, first place out of the top 10 countries in the world and that sort of thing. So again, kudos to anybody who has interest in charitable giving. So why do we do that? Well, there's a number of reasons. A lot of people, it's very personal why they give. They may have a specific cause that they want to support, a specific organization in the community that inspires them, leaving a legacy or creating a vision for the family, being an example to the future generations. One trend that we're seeing in charitable giving is that people are becoming more and more interested in giving during their lifetimes so that they can see the result and see the power that they have in the tool that their money is to do good things. And not just write it up in the will or some other estate plan technique to leave it after they've passed, but to see it working now. And so the second one from the bottom there, that bullet point, that says, see our dollars at work, that's what that's referring to. And I have a very short example of that. From my own donor advised fund, I decided to send a chunk of money to my elementary school that I attended when I was a kid. And specifically, the organization that I use for my donor advised fund allowed me to write in just a little tidbit of what I would hope would happen with that money. Of course, the school leadership will do what they want to do with it. But I said, if possible, can you give it to Mr. Frazier's second grade classroom? Because he was my teacher in second grade. I still remember that guy, fantastic guy. And the reason I'm telling this story is because it ended up being really neat in a way that I didn't expect. I didn't know that it would be shared, who did the giving in this case. And what he had do was every child in that second grade classroom wrote me a letter, on the elementary school, like lined paper with their second grade kind of handwriting and thanked me and shared what they used the money for. So some used it for pens and paper, some of them used it for a new lunchbox, et cetera, et cetera. That was just really heartwarming for me. So I'm a big believer in doing what you can to see your dollars at work if possible now. And then the last one on this slide I've saved for the last because that's what we want to dive into with the balance of our time. And that is to talk about how can you do giving in a way that is also efficient from a tax perspective. Because if you're going to do this, because you're charitably inclined, you might as well do it in the most effective way that you can. If you want to scan your eyes over this, this is where the money went to in our country. Top four, kind of interesting. Okay, so we're going to get into a little bit of the technical stuff now. What you're looking at is a breakdown of what we call the AGI limits. So when you give to charity, you're subject to an adjusted gross income limit. So what do I mean by that? If you look in the upper left-hand corner, you'll see a 60% rate there next to the cash line. And I've got this new tool that I'm going to make sure help you guys out. I'm hoping that you can see that blue circle or oval I just drew. So that's what I'm referring to right now. So what that means is if I have $100,000 of adjusted gross income, to keep the math simple, and I give away that entire $100,000, all that income in cash, I actually cannot deduct all 100,000 of that. I can only deduct 60,000 of it because I'm subject to the 60% adjusted gross income limit. And the reason this slide is really important is because I want to call attention to the portion there at the top where it mentions that it was 100% for the past couple of years. And so I don't think it's been really well communicated that that went away. I've talked to a couple of CPAs and they were actually unsure themselves. Some of my friend CPAs in the town that I live. So just make sure that you're aware of that. If you've enjoyed that in the past, it's not available for 2022. It was written into the law only for 2020 and 2021. So we're back down to the 60% rather than 100%. Some of the other things to be aware of that have changed on the technical front, a couple of things that also went away because they were only available for 2020 and 2021 are that corporate giving limits went up. That's no longer available in case that who are involved in the corporation. Same exact story for the, what some are calling the above the line deduction. Even if you were somebody who only took the standard deduction and were not able to itemize your charitable giving, you could still take a charitable giving deduction above the line, or some call it an at the line deduction. We won't get into the technical aspects of the 1040 on that right now, but just wanted to call out your attention that that's not available this year going forward either. So in case you're asking the question, well, what is this above the line stuff? Let me explain. Below the line is what you're used to hearing about when it comes to deductions. You can deduct your home mortgage interest, your gifts to charity. That's on the bottom of the slide here. This is done on Schedule A. Those are the more common below the line deductions, but what we're talking about when we say above the line is this list here, and this is where you got to add in that extra little charitable giving amount that the IRS is making available just as part of the CARES Act. So one thing that's important to help lead into the discussion on one of our most preferred strategies in charitable giving is to talk about the change that happened to the standard deduction back in 2018. So if you look at this graph here, this table, I should say, if you look in 2017 and you look at married filing joint, in 2017, the standard deduction was $13,000. And then you can look and see what it is now for this year. So that big jump occurred in 2018, essentially doubled the standard deduction. Well, why does that matter to us as charitable givers? Well, it matters to us because if you are itemizing, like we just looked at on the Schedule A of the 1040, and you're trying to get a deduction for your charitable giving work, it's actually a little bit harder to do now because the hurdle to get over the standard deduction, which anybody can take, even if they don't itemize, got higher. So some other things that happen to the itemizations that make it harder to get over that hurdle, along with what we just talked about, are the state income and property tax. Some people refer that to the SALT deduction that got capped at $10,000, where there was no cap before. So if you have high property taxes, that was an out. And some other things happened as well. So that makes it harder to be able to itemize. In fact, after this change, if you look at the second bullet point down on this slide, only about 90%, only about 10% of people itemize their deductions now. It was 30% before, now it's only 10% in the country. So one of our preferred strategies in helping us get above this hurdle rate of the standard deduction to actually make our charitable itemizations actually count, so to speak, is bunching. So if you look at the bottom of the slide, you'll see the second bullet point from the bottom is bunching. And that's what we want to focus on right now. So what is bunching? Some people refer to it as stacking. Basically, what you're doing is you are moving your giving that you usually spread out year to year, and you're placing it all in one year. So it's accelerating or deferring your deductions. That's really what it is. It's an acceleration technique or deferment. It's not new. People have been using it for many years. It just matters even more now because it's harder to get yourself into itemizing on your tax return. So here's an example. This is, we'll say, a couple here, and they've been doing this sort of charitable work for the past 4 years. We're looking from 2018 to 2021. For those of you who are technically inclined, you'll say, well, the standard deduction isn't going up a little bit that it does every year. And you're right. To keep the math simple, we just made the numbers even. So if you look at the first top half of the slide, you'll see that this particular couple in 2018, they maxed out their $10,000 SALT, income and property taxes, SALT, and local and state tax, local and property taxes. $87.50 for the mortgage interest. So they've still got a mortgage they're paying on. This is a younger couple. Charitable contributions, they've been giving $5,000 a year to charity. And that comes to a total itemization of $23,750. So we're right in this first column right here. So why does that matter? We'll compare it to the standard deduction in that area. So even though they gave $5,000 to charity, it did not help them. Of course, it helps the charity, and that's the primary motivator. But it didn't help them at all on their taxes. Because if they hadn't given a cent to charity, they would have still been able to claim that standard deduction of $24,000. So that's the issue. That's what we're trying to get at. So over the 4 years, they would have been able to deduct $96,000 over there on the right-hand side, because that's the 4 years added up. Now, if they were to implement bunching, again, up here at the top, we have our state and local taxes limit at $10,000. The mortgage interest is there, but they didn't get the charity. They defer it to the next year. So they give 2 years all at once in 2019. That's what they did. So that's why we have a $10,000 amount here and a zero amount in the previous year. So what that means is in 2018, they get to take that standard deduction. We already pointed out that if they didn't do any charitable work, they still get that standard deduction. So they still get to deduct as much as they would have. In 2019, they actually exceeded the standard deduction hurdle with, as you can see, the figure there of $28,750. So in that case, the charitable deduction actually did, in a way, help them because they were able to deduct that on their taxes and pay less in taxes. And then they repeat the same strategy over the next couple of years. So what does that mean? That means at the end of it all, they actually get to deduct over $105,000, whereas in the other case, it's less than $100,000. That was a mouthful. The takeaway is that without being any more generous, they're actually able to receive something in the way of tax deductions, whereas they wouldn't have otherwise. So we're not asking anybody to, give more money or do something you're not comfortable with. Just be more thoughtful and strategic in the timing of how you do it, and that can make a difference for you. Now, here's an example of a different household. They're a little bit farther along. They don't have mortgage interest anymore. So again, we're looking here in 2018. They already paid off their mortgage. They give more to charity. So right off the bat, they are exceeding the standard deduction. So maybe you think, well, they don't need to bunch. They don't need to do any of this stacking technique. They don't need to think about this because they're already getting over that standard deduction hurdle. They're actually getting some benefit for the charitable giving, but it still applies to them because if they implement the same strategy, it helps them to an even greater degree. So if we go down to the bottom and we look at the same exact concept, they double up their charitable giving in 2019. That's what they did. That ends up being $40,000 in itemizations that year. So at the end of the 4-year period, that's a really big difference where they're able to have $28,000 more in deductions than they otherwise would have. That's why this is a powerful concept. And again, you don't have to give away any more money. You're just doing it more strategically. So the most common, I'll just say pushback. The most common concern that people have with this is they're like, well, I always give my money every year to, XYZ charity down the road. I love those guys. They know me. And I'm afraid that they're going to say, well, Chris, what about your gift you usually give us this time of year? What happened? Did we fall out of favor? So the answer to that, and we'll talk about later, you can still be able to spread out your giving in a way where the end charity will not know the difference. They will still receive the money the same every year, but you can still implement this strategy by using a donor advised fund. We'll get into that a little bit more later. Okay, so our second, one of our more preferred strategies is qualified charitable distribution. So we talked about bunching already. Now we're going to jump into what we know affectionately as QCDs. So a charitable distribution that's qualified is pretty cool. They first became available in 2006. It was made permanent in 2015. You used to have to wait till the end of the year to see if it was going to be renewed or not. But now it's always there, unless, of course, they make it unpermanent with legislation. But in a nutshell, what it allows you to do is send money from your IRA directly to the charity, which means that instead of taking money out of the IRA, having to claim that as ordinary income, and then try to offset that by giving the money to the charity and claiming a deduction, all that rigmarole goes away. With a QCD, charitable distribution, the income never hits your 1040. You never have that extra income. It saves you a couple of steps. And some say, well, if I do it the other way, which I'm used to, it's a wash. But here's the thing. Not only does it save you a couple of steps, it actually can help you in a way that maybe you didn't anticipate, because some of the rules and what you pay have to do, let me just jump ahead here for the sake of time. Right here, this is what I'm trying to call out. So the amount, the portion, I should say, of your Social Security that you have to pay, being able to deduct medical expenses if you have some, the income-related monthly adjustment amount on Medicare premiums. Those who earn more money have to pay more for Medicare, as well as a net investment income threshold. All those are based on what is your level of AGI, your adjusted gross income. So you don't want to take a withdrawal from your IRA and then give it to charity and do the deduction. You don't want the money to ever hit your tax form at all. So if you do a qualified charitable distribution, it keeps your AGI lower, potentially saving you money in other places as well. So that's why that is so popular. Just a little more information about QCDs is that it does count towards your required minimum distribution if you're of age where you need to do your required minimum distribution. So that's nice. It counts for that. You know, if you don't need your required withdrawal, just send it straight to charity and keep it off your tax form entirely. You have to be 70 and a half to do a QCD. And some of you may be saying, wait, I'm confused because I thought required minimum distributions, I thought that started at 70 and a half or actually 72. And you're right, it used to be 70 and a half, but it got changed. Legislation changed to 72. However, there's a little discrepancy here and it confuses some folks. To be able to do a QCD, that is still 70 and a half. So you can do a qualified charitable distribution as long as you're 70.5 at the time of the gift. The limit is $100,000 per IRA owner. So if you have a couple, you can do his and hers in the household, and it's got to go straight to a charity from the IRA. And the caveat with that is it's got to go straight to a public charity. So foundations and donor advised funds, those are popular charitable vehicles, but they're not what's called an operating charity. They're not the end charity that's actually got boots on the ground doing the work with the money. They're more of a holding tank. So a QCD cannot go to a donor advised fund. It cannot go to a non-operating foundation. So make sure you pay attention to that. And I would just double check with the entity you're thinking of. They should know whether they're an operating charity 501c3 or not. And yes, you can do it from an inherited IRA as well. Okay, how are we doing on time? So here's just some interesting basic rules when it comes to giving the charity. It used to be popular to give stock certificates. I mean, that's kind of gone the way of the dodo bird. It's hard to find a stock certificate these days. If you do see one, it's usually framed on someone's wall, like, you know, something that Disney or whatever, maybe something that's pretty unique for a conversation piece. But if you've actually got some paper stock certificates and you're going to send them in, you got to make sure you do it on time for it to count by the end of the year. When you mail those to charity, it's got to be and this is in the US mail only, so it's when they arrive. But if you use UPS or FedEx, then it's on when they arrive at the charity. So it's something to keep in mind. We almost never come across this anymore. But another point is if you do electronic delivery, we've been working off of the presumption that when the stock arrives in the charity's account, that's when you can say that you gave to charity. Again, we care about this stuff just because you've got end of year deadlines. And every year we see this. November, it ramps up. People started thinking about it in October. December, there's this mad dash. And I've seen people not be able to get it done, even though they wanted to get it done, because the organizations just can't process all the paperwork. So be one of those folks that gets in line early, so to speak, when it comes to this. In case you're wondering, when you give a stock, it's going to be the amount that you're going to be able to claim as the amount that you gave to the charity is just an average of the high and low price of the share on the day that it's delivered. That's something that our ops back office would take care of. So if you're giving cash, so that includes checks, of course, physical cash, that is deductible at the time you make the gift. If you mail a check, it's when the check is mailed. So that postmark could save you. But be careful not to post date the check inside the envelope, because then it's not going to be able to count until the date that you post dated it to. It's a credit card you're using, it's when the card's charged. And I've not seen this, but apparently if you do it via texting, then it's when the message is sent, because you've got the electronic stamp on there. Okay, so we already talked a bit about the deductibility of your charitable gifts. When it came to the AGI limits, there is the table that we looked at before. So that's what this is referring to at the top of this slide, the nature of the gift and the recipient. So the nature of the gift would be whether it's an appreciated stock or some other type of long-term capital gain or short-term or tangible property. That's the nature. And then who you're sending it to, whether it's a public charity or whether it's a private foundation, that changes the adjusted gross income ceiling that you have with charitable. Something to keep in mind is that if you do give enough in proportion to your AGI that you're not able to deduct it all in that year, it's not the end of the world, because an excess gift does carry forward for 5 years. Keep in mind that if you continue to give to charity each year, that current gift is what's going to be counted towards your AGI limit. So if you give enough that you're hitting the AGI limit every year, the 5-year carry forward eventually is going to expire and you won't be able to use up some of those. Okay, so here's an example to walk through. We have John in this case. He's giving some appreciated long-term stock to a private foundation. So that means we just jump back to our slide and we say, okay, he's giving some appreciated stock to a private foundation. We look right here, okay, that's going to be at the 20% AGI limit. So that's what we use. His AGI is 100,000. He's giving $50,000 worth of the stock. So we just looked up and saw that it's a 20% AGI limit. So 20% of 100,000 is 20,000. So he's able to put on his itemizations 20,000 of the 50. So again, just calling out that you may not be able to deduct all that you give if you hit the AGI ceiling. That's something that you can work through with one of your advisors. So at the very bottom, the 30,000 that he's not able to deduct in that year, again, it's okay. You can use that as a carry forward for the next 5 years. All right, let's go through an example or two of some efficient ways to give that we haven't already talked about. And this one has got a lot of highlighted yellow on it on purpose, because this is one of the best strategies when it comes to gifting. It's, if you run the numbers, doing it this way versus another way, usually this one comes out on top, and that's something that we can do for you. So in this case, we've got Sally. She owns She wishes she had 100,000 shares. Sally owns 1,000 shares of XYZ stock. It's worth 11 bucks, and she wants to give it away to public charity. She only paid $1 for it, so her cost basis is $1. She's got $10 of gain. And then for our fact set here, long-term capital gain rate for her is 15%, and she's at a 35% ordinary tax rate. Just to make the math simple, we've got this little table right here. So she's giving $11,000 of value to the charity, because that's what the XYZ stock is worth, total. Now, the first example on the left here is, what if she sells the stock, which kind of makes sense, right? I have the stock, I want to give some money to the charity, I'm going to sell my stock and then take the proceeds and send it over. Well, if she does that, this is what she's looking at. Starting from top to bottom here, she gives up $11,000 to the charity. Because she sold it and her capital gain rate, her long-term capital gain rate is 15%, she's got to pay taxes of 1,500 bucks. So that means after she does that, there's only 9,500 left to actually give to the charity. So they're going to receive the 9,500. And because she did give the charity, she's got a potential tax deduction there with the itemization. So she's going to have about a $3,300 tax savings from the gift. Now, since she already paid some taxes, though, you got to subtract out the $1,500 she already paid against this tax savings. So really, net tax savings for her is only about $1,800. All right, let's walk through the other side and see the difference here. She decides to gift the shares directly instead of selling them first. That is a winner move. That's a pro move because she doesn't pay anything for selling it. Doesn't matter what her capital gain rate is. She did not sell the stock. She doesn't have to pay a cent on that. So the value of the gift to the charity in question is more. So the charity's happier. They don't mind receiving the whole shares. Most charities these days are set up to receive whole shares. This happens all the time. So don't be surprised when they do say, oh yeah, here's our brokerage account. You can send it over to this. So you send it directly without selling it, so they get a higher value. And then as well, because they received more, you get to deduct more, in this case, $3,800. And since you didn't pay any taxes at all, you don't have to reduce it by the previously paid taxes. So in this case, she has a total tax savings of $3,800 versus $1,800. And this is a simple example with small numbers, but if you extrapolate this using larger numbers, it gets really powerful really quick, because that's a big difference between $3,800 and $1,800. So gifting appreciated shares is the way to go. Please, if you can, don't write a check to charity if you're trying to do it in an efficient way. If you've got some appreciated shares around, that is a great way to do it, because the only person that gets cut out of the deal is the IRS. All right. So let's talk about now how to set things up so that upon your passing, you're doing it in a tax efficient way, in the way that you transfer your wealth to either a charity or some family members, the heirs in your family. On this slide, there's a bit of legal jargon, but what I really want you to notice is that with an IRA, qualified plan, annuities, those tax deferred vehicles, there is no cost basis adjustment at death. That's key because that helps drive the following strategy. So here's an example. This individual passes away with an IRA and just a standard brokerage account. They've got $50,000 in each of them. The brokerage account has a cost basis on the $50,000 value of $10,000. So it's appreciated $40,000 since they've owned the stock. So this person passes away, and we want to go over how should they write this up? How should they make their estate planning documents and make their beneficiary designations in a way where this is the most efficient way to do it? So what their intention was and what they wrote up is at the end of the day, they want half of their money to go to charity and half to go to their kids. So I ask you, in your opinion, which option would be better? It's easy to split it 50-50, but do you give half to the heir from the IRA or from the individual account? Or do you choose option 2, where you go ahead and give the individual account to the kids and the IRA to charity? Which one is more efficient? If you'd use your question and answer tool and give me a quick vote here on whether you would go with option 1 or 2, I'm curious to see what folks are thinking. And then we'll go over in detail the answer. So right now it's pretty split. Some are choosing option 1, some are choosing option 2. Look like the option 2s are a little heavier in the vote now, but it is pretty split. So let's go over now, and you guys can answer for yourselves what would be better, choosing option 1 or option 2. So option 1, is this a tax efficient transfer of wealth? So we go ahead and list on the IRA beneficiary to give the $50,000 IRA to the child. In this case, the child just go ahead, I want the new Tesla 3. I'm going to take that $50,000 and I'm going to go buy a Tesla. So they've got to pay taxes on the withdrawal of all that IRA, and we're just going to assume a 20% effective tax rate in this case. So after taxes, they end up with $40,000 to go buy the car. The $50,000 brokerage account was given to charity. Charity, of course, isn't going to have to pay any taxes on those gains because it's a charitable institution. So 40 went to the car for the kid, 50 went to the favorite charity, and $10,000 went to the IRS because of the IRA withdrawal. Okay, that's option 1. Let's see what you think about option 2. What if we say we give the brokerage account to the child, or your heir, whoever that is, and because of the cost basis adjustment that you do get on a brokerage account, remember we established that you don't get cost basis adjustments at death on IRA accounts, but you do on a brokerage account. And in case you're not familiar with that term, it means that when you inherit a standard brokerage account, it's not some sort of retirement account, those shares in there will have a cost basis. Let's say my dad gives me some shares of Microsoft. He paid $5 for them. They've grown to $50 now. Fair market value is $50. This is a long time ago. I'm not going to have to pay anything on that $45 gain because you can elect to mark the cost basis of your inherited shares what the fair market value was when the person who's giving the account away passed away. So that means in this case, long explanation, but that means in this case that the heir receives a cost basis adjustment, and so they don't pay any taxes on receiving the brokerage account. The IRA goes to charity to meet the 50-50 split requirement of the deceased. And of course, again, the charity doesn't pay income taxes on that. So how much goes to the IRS? 0. So option 2s, you have it. And this is a simplified example, but it's really amazing to me how often I will see accounts where it's just so easy to list the kids as a beneficiary on the IRA. It's very common, it's very easy to do. But if you have assets and you want to be sensitive in the taxation of those assets, you can do things other ways. You can establish a TOD on your brokerage account and basically put a beneficiary in it like you would in an IRA. So we see this all the time. And the best time to plan is now before it's too late. We've talked about this quite a bit already. Essentially, traditional IRAs are great to give to charity, not so great to give to individuals. Roth IRAs definitely are not great to give to charity if there's any other options, because Roth IRAs are just great to inherit because there's no taxation at all. Okay, we're on the home stretch now. So let's compare and contrast a little bit private foundations versus donor advised funds. Let's start with private foundations. Those always are in the headlines. Those are fun. Starting at the top, if we were to talk about the disadvantages of having a private foundation is, well, one, they're expensive and complex to create. you've got to get lawyers involved and you have to put a team together, and you have to do that. They've also got to annually file taxes. There's a private foundation form 990 that's got to get filled out every year. So again, more professionals involved to take care of that stuff. They have an excise tax on their net investment income. Remember, a private foundation is more of a holding tank rather than an end charity. So because of that, usually they're paying 2% of their net investment income. And they're required not to be a holding tank forever. They've got to take 5% out to give to end charities. So they have an annual distribution requirement of 5%. That's a law that they're held to. So a lot of things to keep in mind if you're going to be part of a private foundation. Some of the advantages to those is that you have a lot of control over it, right? You built it. You can give grants to individuals. You can have family members serve on the board. You can even pay them a market wage for doing that. So if you're wanting to put together a family legacy of being involved, a private foundation could really very well make sense. And you can deduct the administrative expenses of running a private foundation. So we already touched on some of this already. One thing that people don't realize is that tax return is open to the public, so there's a lot of scrutiny on private foundations. A lot of states also require some financial reporting. So this is really only good for, at the bottom here you can see, rule of thumb is really only good for folks who are interested in at $1 million, probably more than that, honestly, to give to charity through private foundation work. If you want to make it like, it's almost kind of like your hobby, it's what you're interested in spending your time doing, it might make sense. A donor advised fund. It's a miniature version of a charitable foundation. In fact, most places where you get a donor advised fund, including those folks that partner with Baird, you can name it whatever you want. Mine is named the Dolan Foundation. It's not a private foundation, but it's the Dolan Foundation. That's the name of my donor advised fund. You can open this up through an advisor. Most large financial institutions have these. Again, we have some great partnerships in place to make these happen. So here's the neat thing about the donor advised fund is you do get a tax deduction up front. And then you put the money into the donor advised fund where it sits kind of like in a holding tank, but it's invested. You can have your money manager, your advisor handle that. And so over time, like an account that's invested over the long term, it's growing, and you can choose over time to donate. So this is where I had referred to earlier, if you're going to do the bunching strategy and your favorite charity is saying, oh, Mr. and Mrs. Smith, what happened to the money you send us every year? Is everything okay? They're not going to say that if you use a donor advised fund, because you'll put the bunched amount into the donor advised fund, but then only piece out or give a grant. You grant out the amount that they're used to. And so then that second year's worth is in there again for the next year. So you can get the tax deduction for all of it up front, yet still have control over the timing and investment mix of this money over time. A main advantage is that it's a lot easier to create and fund than a foundation. Just a little bit of paperwork. You don't gotta go hire lawyers and CPAs to be part of your team to make it happen. It's not open to the public in the same way. So some disadvantages are that there's a lot of times there's limited investment control. It just depends. At Baird, you're not going to run into that as much. But if you just go to some random donor advised fund institution, sometimes they're just going to give you a short list of preset mutual funds to choose from or something like that. And technically, when you've given the money to the donor advised fund, it's not yours anymore. That's why you get the deduction for it. You've given it away to a donor advised fund, which counts as a charity, not an end charity, but a charity. And so push come to shove, they may say, no, you can't give money to such and such charity because they're going to do the due diligence for you. You actually want that. They keep you out of hot water because they're doing the behind the scenes work. They're the ones that have got everybody hired to make sure it happens. So you're technically an advisor on the grants that you want to get to charity. Although I've yet to talk to somebody, one person over the past 10 years who couldn't give money to who they wanted to from donor advised fund, but that's because they were trying to basically give it to their friend, and it was like a super, super small 501c3, and institution vetted that, and that didn't go through. So the overall idea is you give to the donor advised fund, the DAF, we like to say, it grows and you grant. So give, grow, grant, just a nice little. Again, there's more good things about the donor advised fund. We'll just talk about the one at the bottom. So as I mentioned, it's a holding tank. And unlike a private foundation, it doesn't have a 5% distribution requirement. There's no law around that. In fact, the IRS kind of is a little frustrated with donor advised funds because some of them are just collecting and they're not actually paying out to end charities. So if you get into donor advised funds, do some work and actually give the money to end charities at some point. But it could last into perpetuity. It's possible that donor advised funds would just last generations. And so on a donor advised fund, you can put on their successor donor advisors. So that allows your children to take over, or whoever you want to take over, and be the one in charge of making the decisions on which grants are recommended on the donor advised fund. That's pretty cool. And you don't have to put your name on it. This is the second bullet point down. I did because I thought it was cool, to be frank. But if you really don't, and even if you put your name on it, you can still send the grant anonymously. So you have that choice. I've done that as well. When you actually make a grant, you can choose whether your name. Okay. So who would benefit from a donor advised fund? Well, if you're not looking at $1 million plus, maybe it's a smaller number, 5,000, 10,000, $250,000, something like that. Donor advised fund is going to fit you really well. A really nice way to use these is somebody who's getting a spike in income. Maybe they've got a much larger bonus than they're used to at work, or some proceeds from a sale went through that they're not used to. If you want to offset some of that income and you are charitably inclined and you're thinking, well, someday I'm going to give back to my alma mater or something like that, why not make that someday today and offset that spike in income with some charitable giving that you can enjoy? If you're not sure who to give to, you actually don't have any favorite charities at the moment, but you do want to do this work of charitable giving, and you're thinking that it's a good idea and you want the tax deduction, you just don't know where to send the money yet, use a donor advised fund, because then you can just wait and recommend a grant the next year or years down the road. All right, so that brings us to the end. Some of the key things we've talked about today is bunching deductions to maximize your charitable giving. We've talked about QCDs that keep the income off of your tax return entirely. IRAs, traditional IRAs, are great to give to charities at death. They don't pay taxes on it, neither do your heirs. And donor advised funds are a great way, a simple way to get into charitable giving and maximize your tax benefits. So I hope some of this has been really helpful for you today. I've enjoyed your participation and seeing some of the comments come in. I'll go ahead and turn the time over back to Justine.
Great. Thank you, Chris. We really do value your expertise here. Before we begin with the Q&A, I am going to remind everyone, if you would like to ask a question, you can do so via the Q&A icon on the bottom right-hand side of your screen. I know a lot of people have been using it throughout the presentation, and I do see quite a few questions in here already. So Chris, I'm going to pass it back to you for the sake of time to get started going through some of these questions here.
Great. And the first question I'll start with is a very, very good question. And I think I do have a slide in there that refers to this, but not in detail. And that is, our donor advised funds fee-free. So they do have costs associated with them. They're not completely free because if you're going to have investment management inside of there, there's always somewhere some costs associated with investment management. And as well, the donor advised fund company, they're the ones that are doing the due diligence on whoever you're sending, a grant recommendation to. They've got to make sure that they do all the legal reporting properly. They keep on file all your grants, and they're doing the reporting on the taxation and the tax forms and all that. So they do charge an administration fee for that. The administration fees are really, they're nominal, in my opinion. They're not a lot. Talk to your advisor, and you can go over the different options that Baird has, and you'll find one that suits you and feels right to you. All right, let's look for some more questions to answer here. Here's one about QCD. So qualified charitable distributions, can they be sent to a foundation that is a 501c3? So to be safe, I'm just going to say no. But foundations can be a little bit tricky because some of them do have an operating arm and some of them have a non-operating arm. And so depending on which foundation you're talking to, if you have your favorite city foundation, just talk to them and just find out from them. If I send a QCD to you, is that going to work? A lot of times the answer is going to be no, but some of them can. They've just got to do it right and they've got to be set up for it. So be really careful with that. QCDs, charitable, qualified charitable distributions. I've got to go to an end charity. Donor advised funds and private foundations are not generally that. Can you do a QCD from a SEP? My understanding is that yes, if it's inactive, same with a simple. So talk to your financial institution about that to ascertain that. Can you do a QCD from a 401k or 403b? All that I followed is around IRAs. I can't say that I have seen that or am familiar with that. That would probably be something good that we can add for our next learning session together. I think I've seen that question. Mark, we'll see if we talk to your advisor, if you would please, to indicate who you are, and I'll make sure and get that answer to you directly. Churches can, yes, be included in bunching, assuming they're a 501c3, then certainly that could be done. That's all we've got coming in right now. I can see. We are pretty darn close to the top of the hour, so this is probably a really good spot to call it a day.
Great. Thank you so much, Chris. Again, we really do appreciate it. Thank you everyone for your time on the line today. As a reminder, for those who'd like to review today's presentation, share it with a friend, family member, colleague. The session has been recorded and will be made available in approximately a week through your Baird financial advisor or via bairdwealth.com. If we were not able to address your question or you would like additional information, as Chris mentioned, please feel free to reach out to your Baird contact and they'll connect you with the appropriate Baird resources to get those questions answered for you. So with that, thank you again, everyone. And Chris, thank you so much. Enjoy your afternoons.